Good evening, everybody. Thanking you for joining us here this evening on the monthly market insight in the second week of May. We've, of course, been hosting this event for several months now, and we are going to be following a pretty similar template as we have done in previous months. The way we will conduct this event is that first we'll start off with a presentation where I'll cover some of the macro-related issues confronting the market. We'll talk about valuations because no conversation about the market is complete unless you have a perspective on valuations. After that, today, my colleague Amit Premchandani will be joining us on this webinar, and he will be talking about the Value Opportunities Fund, which he manages and has been managing for 4 years. Of course, he was co-manager with me for a very long time, but effective January, he's on his own managing the strategy. So he'll be talking about how he manages the Value Opportunities strategy today. So that's the format we'll be using. And as always, we've already received many questions from you, and we'll also look forward to live Q&A from you as we move to the question and answer session. And my colleague Niranjan will be pulling up the presentation on the screen, which we will be running through and using as a guide today. So without any further ado, we'll get moving on the presentation. So yes, what we'll be talking about is equity markets and the UTI Value Opportunities Fund. Moving on to the equity markets section. So I know there's been a lot of volatility in the last few days, very sharp moves up and down. And in fact, I wrote about this in our monthly fact sheet commentary, which was released on Thursday. And those of you with interest, do look it up. It's on our website under the CIO commentary section. Markets have been going through, these sharp up moves and down moves because of various, moves by central banks, including in India, have begun to tighten monetary policy, increase rates, and suck out liquidity, and therefore it's been quite volatile. And of course, we've been in some kind of a correction phase for quite a while now. If you look at this chart, it shows you the way various sectors and markets have behaved over 1 month, 3 month, and 1 year. And as you can see, over a 1 year basis, whether it's mid caps, small caps, large caps, everything is very strongly in the positive territory. But once you telescope down into the 1 month and 3 month period, this is of course data as of the end of April, you'll see that many of the sections of the market have experienced losses. And in fact, in the first week of May as well, markets have been down quite sharply. The only sectors which have held up very well in recent months have been the commodity sectors, essentially energy and commodities, simply because and helped quite significantly by the supply side disruptions which have come about because of the Russia-Ukraine conflict. So that's been the strongest part of the market, so to speak. But moving on to the next slide. This gives you some perspective over India's performance relative to other geographies. And what's interesting to note over here, particularly when you look at 1 month and 3 month, is that the stronger performances have come from commodity heavy markets, Russia, Indonesia, right at the top, and even markets like South Africa, Brazil doing much better now on a 1 year basis. India somewhere in the middle of the pack, not doing as poorly as some other markets, but equally not the best performing market, with some of the commodity heavy markets have moved into that position. For example, in the Asian context, Indonesia is the best performing market. And of course, on a 1 month basis, Russia, after the sell-off in March, has recovered quite sharply. But as you can see, Russia on a 1 year basis still very much bringing up the rear. But this is important to keep in mind. The market's not done much over a 3 month or 6 month basis. And we'll see what effect this has on the later slides. So moving on, as we always do, to a understanding of what earnings have been doing. This is the slide on the earnings. You can see the earnings estimates for March 22. Results are still coming in. I think it will take till the end of the month before all the results are reported. But the market is estimated, the Bloomberg consensus is 37% growth in earnings for March 22 for the Nifty 50 companies. We appear to be pretty much on track, which we'll see on the next slide. But this has been a very strong year for earnings growth. And when you look at the context of a negative to flat market over 6 months and strong earnings growth for the full year, it's resulting in a derating. And we'll see evidence of that on one of the later slides when we look at the market. But moving on to the next slide, we've got the trajectory of earnings. So that should be coming up on your slide. So just take a look at that yellow line. The yellow line is the earnings estimates for March 22. And as you can see over there, it has pretty much been consistent, except for the slight dip that we saw in about August of 21. Very likely that was the impact of the Delta wave of COVID. But other than that, the earnings estimates have stayed reasonably robust and very strong earnings growth compared to the slightly pale blue line that you see below the yellow line, which was the actual earnings estimates for the Nifty in March 21. So as you can see over there, very sharp jump from the March 21 level to the March 22 level. Earnings still an estimate, expected to go up 37%, but I think we are tracking quite well in terms of actually achieving that number. So that's what has happened. Markets flat over a 6-month period, earnings rising sharply. So we can move to the next slide, and this will give you some context. So when you see a market which has gone nowhere in terms of price, but earnings have moved up, in effect, it has driven a PE derating of the market. On the left-hand side, you can see the trailing PE. Now, the trailing PE was at its worst point somewhere in 20 when the hits were coming through in terms of earnings. And then as the earnings have surged, even though the market has gone nowhere over the last 6 or 7 months, today's market is close to the levels that we were trading in August of 21. So you can see that over the last 6 months, there's been a sharp derating of market because prices are down slightly, but earnings are up very significantly, thereby bringing about a derating of the market on a trailing PE basis. On the right-hand side, you can see that now the derating is also showing up in forward earnings, right? So analysts estimate that earnings for the Nifty 50 will grow by 18% in March 23. We'll talk about some of the risks to that later. But presuming that number is correct, you have now got valuations on a forward basis as well, dropping into the fair value zone, which is plus or minus 1 standard deviation of the long-term average. That's the fairly valued zone. And now, even on a forward basis, valuations for the Nifty 50 have actually dropped into the fair value zone. So, when you look at the market unchanged over 6 months, but earnings going up, in effect, it has driven something that we always talked about, that there is no more scope for the PE to go up. And in fact, it is only earnings which can drive the market, but the market has also started to derate as those earnings have come through. And that's what is visible here. If we go to the next slide, this is really the price to book. Now, the price to book looks very different at this point of time. It is still trading in the expensive zone, but I am not reacting too much to it. It certainly suggests the market is still sort of pricey at 3.2 times book. But there is a reason why, the price to book is higher than history. And the reason for that is the right side chart, which is the return on equity of the Nifty 50. Now, remember, from March 20 to March 22, Nifty earnings are up by almost 50% or more. Now, because of that, there's been a sharp rise in the ROE of the Nifty. In fact, the May 22 exit number for the Nifty in terms of ROE is the best that we have seen in almost 8 years. So if you see that chart carefully, you'll see that the last time we reached this 15% mark was actually sometime in 2015. So it's almost 7 to 8 years since we got to that level. So it's not a surprise that as ROE has moved higher, as a result, it has also managed to drag the price on book slightly higher than the historical number. This is as far as large caps are concerned. On the next slide, we have the mid caps and small caps. We haven't got the PE chart here. What we've got is the price to book. But I would sort of essentially highlight that whereas the large caps in terms of their price to earnings multiples have sort of come back into fair value zone, the same has not happened in the mid cap and small cap space. And on a price to book, as you can see here, the area remains rich. But even on a price to earnings basis, this area of the market is yet to sort of pull back into the fair value zone of the market. So that's really the area which still has some valuation challenges as opposed to large caps where a lot of PE derating has already happened. So if we move on to the next slide. Right. So all the slides that we've seen so far in terms of valuation are really a comparison of equities relative to their own history. So we are looking at the PE multiple and comparing it to the past PE multiples. We are looking at price to book, comparing it to the past history of the price to book. Here, we are doing an inter-asset class comparison. We are comparing the yield on equities to the yield on the 10-year government bond, because there is a relationship between different asset classes in terms of those yields play out. Now, if you've been tracking fixed income markets, you would be aware that there's been a very sharp move in yields in the 10-year bond, right? It's gone up by almost about 70 basis points year to date. So as a result of that, when we look at the relative gap between stocks, which is the Nifty 50 yield, and the 10-year GSEC, the difference is 180 basis points in terms of equities being more expensive than bonds, whereas historically, this gap is closer to 1%. So we are at a 2% gap as compared to the history of 1%. Which suggests that on an inter-asset basis, at this point of time, equities have still not really come back into what we would call the historical, sort of fair value average. So this is as far as equities versus bonds are concerned. On the next slide, we have a comparison of mid-cap vis-a-vis the Nifty. And what you can see here is the premium or the discount. So currently, the Nifty is actually at a 12% discount to the mid-cap index in terms of valuations. The historical number is a 5% discount for the Nifty. So in that sense, there is still a premium in terms of the relative valuation of mid-caps to Nifty. And this sort of points back to what I highlighted earlier, where I said that the large caps are back in fair value, but mid caps and small caps have not yet come back into fair value. And that is what you can see in the slide, whereby, this measure is yet to come back to its historical average. Now, it is never the case. And if you look at any of these charts I've run you through in terms of valuation, it is never the case that the market trades at average valuation. In fact, I would say the market almost never trades at average valuation. But what average valuation tells you is sort of the mean to which values tend to revert over time, because most of the time the value is fluctuating, but the margin of safety is very superior when you are closer to the average as compared to when you are far away from the average, particularly in terms of the premium. So that's it in terms of valuations. Very quickly, we'll move on to the last slide when we are talking about macros. Point one, the US Federal Reserve in November decided that inflation was no longer transient and it would retire that term and start to act to protect against inflation. They are now doing that. They recently hiked rates by 50 basis points and they are on track for a 2 to 2.5% FOMC rate by February 23. So in other words, we can still expect about 5 to 7 rate hikes in literally the next 10 months. There is also quantitative tightening ahead, which is to say that they are likely to now start selling bonds initially at the rate of $45 billion a month, but going up to $95 billion a month by the month of June, which means we would be withdrawing liquidity to the tune of $1.2 trillion per annum if they keep up this run rate on an annualized basis. In India as well, inflation is high. You must have seen the recent prints. Remember, RBI's target is 4% plus or minus 2%. We have now comfortably pierced the 6% range and gone closer to 7%. RBI called a out-of-turn meeting of the Monetary Policy Committee, and they decided to hike rates by 40 basis points. This is on back of a effective tightening, which had already been executed in April. So very clearly, we have now the Monetary Policy Committee and RBI as well pivoting towards anchoring inflation expectations. In the medium to long term, this is a good thing because if you allow inflation expectations to run away, you permanently raise the cost of capital and it destabilizes businesses. So this is a good thing in the longer term, but in the shorter term, it has come as a little bit of a surprise to the market in terms of the timing. Most of India's economic parameters remain in the healthy zone. Forex reserves are at $600 billion. Our monthly imports are slightly above $50 billion a month, which means we have roughly 12 months of import cover. If you remember, 4 years ago, we used to talk of the twin balance sheet problem, which was the poor health of bank balance sheets in India and the poor health of balance sheets in the corporate sector. That is no longer a challenge because now, both these balance sheet problems have been significantly addressed. Government of India has taken several supply-side initiatives, and these are likely to enhance productive capacity, one of them being PLI, changes in the labor code, some of the new policies which are targeted at employment-heavy sectors. All of these are likely to enhance productive capacity. GST collections reflecting a healthy trend, though it must be pointed out that this is also getting boosted to some extent by the higher inflation. Disinvestment making progress at this point of time. The country's largest IPO currently underway and meeting with some degree of success. And finally, outlook for government capex remains positive based on the comments that are coming out from the finance ministry. RBI's last growth estimate for India, 7.2%, which is a very healthy rate of growth. But there are challenges to this rate of growth from the persistence of the conflict in Russia, Ukraine, because this is keeping commodity prices, including food grain prices and edible oil prices elevated, which has a negative impact on countries like India as well as other geographies, and therefore a negative impact on global growth itself. Finally, there is a risk to earnings estimates on account of inflation, higher rates, margin pressures, potential softening of demand as RBI tries to take rates higher and compress demand. There is some upside to profits because some of the commodity businesses may generate higher profits, but typically the market does not pay a high valuation for them. So I would say that there is some risk to earnings estimates. Even if some of that is offset by the profits of commodity companies, there would still be some valuation risk to the market because the market does not pay the same multiple for commodity profits. Finally, on valuations, large caps very much in the comfort zone, both on trailing and on forward earnings, but not necessarily true of the mid and small cap space at this point of time. And relative to bonds, we're still to sort of get back to what we would consider a equation which is favorably tilted towards equities. So I think at this point of time, we have some comfort in large caps, but we would continue recommending staggered investing as an approach simply because of the level of uncertainty and also the fact that we haven't yet come back to a neutral relative to bonds as an asset class. So that about sums up the macro perspective that I wanted to share for today. And I'm going to hand over now to my colleague and fund manager, Amit Premchandani, He's been with us for nearly 14 years, started off as an analyst in the banking sector. He manages our banking fund today, and he's also been the co-manager along with me of the Value Opportunities Fund for nearly 4 years. And now, of course, he's taken independent charge of that in January. And very well placed and I think well qualified to lead that strategy in the years ahead. And he's going to be talking about it in the next section. So over to you, Amit.
Thanks, Vetri. Good evening, everyone, and thanks for joining in. As you know, UTI Value Opportunity Fund is a value-oriented fund with a very flexible approach across sectors as well as market cap. We follow an intrinsic value approach to give a value orientation to our fund as compared to the traditional multiple-driven valuation approaches. What we do is that we have three key levers or pillars to manage the fund. To start off with, the first lever is sector level valuations. So valuation approach is very key to drive our sectoral allocation. However, we use another filter, which is to ensure that the volatility in the valuation-driven approach at a sectoral level is reduced, and that lever is that we do avoid balance sheet risk because it's very important for companies to survive cyclical pressure during downturns. And cyclical pressures can be survived primarily through a deleveraged balance sheet. Just to give example, our investment in auto or pharma sectors, which are key overweight sectors, and lately banking and financial services, is largely driven by the fact that balance sheet of all these sectors are at a very comfortable position, and despite having any cyclical pressure, capital call is absent in the current environment. Second level of lever that we use is the stock-specific barbell approach, where on one hand, we invest in companies which are going through cyclical pressures and challenging environment. Again, we focus on the balance sheet strength of the company and the ability to generate above average or high ROICs during favorable conditions. For example, during the AQR crisis of 2015 to 18, private sector banks' balance sheet were under stress, but we still went on and invested in private sector banks with the belief that they are very adequately capitalized and they have enough operating profit to take care of losses which may accrue. While on the other hand of the barbell, we invest in companies which are having very long growth runway, are relatively reasonably valued, and implied growth is manageable. For example, in 2018, we invested in a few IT companies as they were trading at implied growth of less than double digit with free cash flow yields of above 5%. So both side of the barbell, we try to focus on one side having cyclical exposure and on the other hand having growth exposure. The third lever that we use is market cap. As this is a flexible strategy in terms of market capitalization, we increase or decrease our small cap and mid cap exposure based on where the valuation are relative to large cap. This exposure has moved from anywhere between 15 to 20% on the lower side and 35% on the higher side, and we intend to keep that exposure within these filters. Currently, over the last 1 quarter, we have been steadily reducing the mid and small cap exposure, and currently that exposure has gone down to as low as
Amit, you've gone on mute.
mute now.
Yeah.
So these are we follow certain guardrails or margin of safeties in terms of how we manage our exposure. If you could just move to the next slide, uh, Niranjan. So, intrinsic value in practice is kind of broadly explained in the two blocks that I had written on what we think as value. And in that, we have tried to explain how we use the intrinsic value approach in practice. For example, what we prefer is companies with very healthy ROIC profile over the cycle as compared to companies with erratic ROIC profile. For example, we in the cement sector, we preferred Shree Cement over Ultratech, and that was largely driven by the fact that Shree Cement has a better ROIC profile over the cycle because most of the investment in Shree Cement were organic in nature, and hence capital consumption was pretty limited, and hence ROIC profile was much higher. Although both Shree Cement and Ultratech were very high quality companies. And hence, Shree Cement qualified Satira Paribas. Shree Cement qualified on the growth side of our barbell because of a better ROIC profile despite having slightly higher multiples. We are also open to investing in, for example, weak companies with having weak operating profile at the moment, but have capability to improve the operating profile or demonstrating the willingness to improve operating profile. Just to give an example, we had invested in tractor OEM named Escorts, which was having a very low margin profile as compared to its immediate peer. However, we, after meeting the management, we had conviction that a large part of the operating profile, poor operating profile, is coming from employee cost, which were since the company had very low contractual employees as compared to peers, and the company was trying to move employee base on a contractual term, which would generate very high operating leverage, and that played out. We also look at companies which have decent option values in the form of adjacencies, and especially these option values can be encashed during bad times. For example, both SBI and ICICI had invested in subsidiaries which were value accretive for them. And during the asset quality review time, whenever they were facing any issues in terms of making provisions, they were using their divestment in some of these subsidiaries to provide for unforeseen exigencies, and hence during the entire 2015 to 18 cycle, SBI was the only PSU bank which did not dilute significantly, and ICICI was a private sector bank with a very high NPL ratio in the corporate side, not needing to dilute for providing any losses, rather using the profits from the subsidiary stake sale to provide for these losses. Free cash flow is a metric again which we prefer as compared to other traditional approaches of valuation, and this metric was again used while investing in IT stocks in 2018, when we saw that very high quality IT companies, which were trading at free cash flow yields of 5 to 8%, despite delivering almost double digit growth over the last 2 decades. So these are the positive sides we look at in terms of intrinsic value. Some of the things which we try to avoid while using the intrinsic value in practice is to ignore companies which are having cheap valuation but have issues with respect to terminal value. For example, we had invested in a media company which had very low valuation and very high free cash flow yields. So it satisfied the FCF on the left hand side. However, as we move along, we discovered that the terminal value of that business, the terminal value of that business is reducing or getting eroded because of sharp penetration of OTT, and we kind of completely exited the company. Another example of avoiding low terminal value sectors or companies is the oil and gas sector, where we think that due to the climate change commitment of the country, as well as global concerns on warming, we think that fossil fuel companies have very low terminal value, and generally we avoid having an overweight position in these sectors because we think that the terminal value is low and cheap valuation. Looking at cheap valuation is actually myopic. We also avoid companies with stressed balance sheet, and that led to us not having a very significant or having an overweight position in the metal sector in the 2020 fall, which may not have worked in our favor, but we kind of evaluated some of these companies. But these companies, an aluminum company, was having a debt to EBITDA at that point of time of 5x, and we thought that we will continue with our philosophy of avoiding stressed balance sheets and kind of avoided a overweight position in the sector despite having a lower valuation. In hindsight, we should have kind of taken that exposure, given that that same company now has a debt to EBITDA of 2.5 times. But we continue to manage the fund with the philosophy of avoiding stressed balance sheet companies. So these are broad philosophies of how we use intrinsic value in practice and avoid having a traditional multiple driven approach. Yeah, Niranjan. So as you can see, the chart explains the barbell strategy, where across sectors we have investment in both sides of the barbell with valuation ranges, even in a sector which is richly valued like FMCG, from a 10 PE stock to a 57 PE stock, uh, which gives you an indication that we are on the both side of the barbell. However, cash flow is a hygiene factor for us. So almost 90% plus of the funds are invested in C1 companies. But despite having exposure to both sides of the barbell across sectors, at an aggregate level, if you look at the portfolio valuation, we are at a significant discount to the benchmark valuation, be it price to book or price to earning. However, just to clarify, we use price to book as a metrics to look at the portfolio valuation as compared to price to earning, because earnings can be really volatile, and some of the companies that we may invest in a cyclically tough environment may have negative profits which impact the PE. So we would look at a price to book approach as far as portfolio valuation is concerned. Hence, at a 30 to 40% discount on a price to book as compared to benchmark, our portfolio is having a significant valuation tilt or value tilt. Next slide, please. And as you can see, the lever that we have been using and the primary lever have been sector level overweights, and the second important lever has been the active weight. At aggregate active weight, we have 67%. We have a 67% active weight, and you can see that across sectors or across large cap names, either we have a very large overweight or we have a zero exposure, which signifies our conviction-driven portfolio management. That either we have a active weight in that stock or we have a zero exposure to that stock. So we have, and at the same time, we have a very high active weight across sectors in which we have high conviction. So financial services is one of the significant active weight, driven primarily by the fact that we think cyclically the sector is well placed for acceleration in loan growth. Most of the asset quality issues are well covered. Leading banks are adequately capitalized to fund their growth. And lastly, but very importantly, valuation are significantly are comfortable in the sector, especially among lenders. The second largest activate or the other large activates are auto and pharma. Auto activate is largely driven by the fact that we think. Can you hear me?
Yes, I mean, no. Yeah. You went on mute again.
Can you hear me?
Yes. Yes.
Hello.
Yes, Amit.
Yeah. Auto is the second weight where a volume growth is likely to pick up significantly and after 2.5 years of.
Amit, sorry, your voice is feeble again.
Can you hear me now?
Yes, but it's a little feeble.
Just a second. Can you hear me now?
Yeah, perfect. Yes.
So volume growth is likely to be likely to revive in the auto sector, driven primarily by the 2.5 years of volume slowdown that we have seen, and hence a cyclical upturn across passenger vehicle and two-wheeler segment. Tractor is one segment where we think that volume growth had already played out and it is going through a cyclical correction, and hence we have reduced our exposure in tractors, at the same time increasing our exposure in two-wheelers primarily. The other third large overweight is the pharmaceutical sector. And this is again driven by the fact that it is a high free cash flow generating sector, which is trading at reasonable valuation. Both large cap and mid cap are fairly attractive at this point of time in the sector. And most of our exposure is in the chronic segment of the pharma companies, which is a very less volatile and almost double-digit volume, double-digit growth segment among the pharma in the pharma sector. Just to clarify, pharma is largely our exposure is largely now into more domestic-oriented companies, and gradually we have reduced some of the exposure to US market focused companies and moved it to largely a domestic oriented exposure. Another sector where we are positive is real estate, where we think that low interest rates and increasing affordability are improving the prospect of the sector. The sector has gone through a cyclical downturn for the last 7 and 8 years and has just revived over the last 1 year. And we think that this sector has very long duration cycle, and we are in the early phase of the upcycle. I will just pause at that and hand it over to you, Niranjan.
Yeah, thanks a lot, Amit, for a detailed rundown on the fund, UTI Value Opportunity Fund. So now, over the next 20 minutes, what we will do is we will take the frequently asked questions and also the questions which are coming up online. So just a request to the participants, you can use the chat box which is available over there. So to post your queries, and over the next 20 minutes, we will take as many questions as possible. So the first question for the evening. So this is a question, Vetri, you can take this. So the US Fed indicating that rapid rate hikes is likely to amplify its impact by tightening liquidity. Would US Fed be successful in soft landing, or would that trigger recession, as US has already seen 2 consecutive quarters of negative growth?
Yeah, interesting question, Niranjan. In fact, I think we had written about this in our previous monthly market, in my previous monthly market commentary. So you'll see that in the commentary that was released in April, where there is a lot of data about how successful has the US Federal Reserve been in the past in terms of tackling inflation by increasing interest rates. And I think since the 1960s, there have been 10 such cycles of the Fed trying to fight inflation by hiking rates. 6 times they actually ended up triggering a recession in the process. This include some policy errors, but 6 times there was a recession, and only you would say twice were they in a situation where they sort of managed a soft landing. So the odds are not in their favor. But I think it's very early days for us to presume that you will necessarily reach a recession. I think at this point of time, the market is merely grappling with the fact that policy environment has become more hostile. Liquidity is being withdrawn. And I think as we hike rates, we will also know the true capability of the US economy to absorb these higher rates. Remember, the US has a debt load. The government has a debt load of $30 trillion. US GDP is about $24 trillion. If rates go up by 1%, so 100 basis points, that is a additional cost to the economy of nearly $300 billion, which is over 1% of GDP. So we have to see how well the US economy will be able to absorb it. But make no mistakes, the US economy is actually red hot, which is why the Federal Reserve is responding so aggressively with policy. So I think it's very early to sort of think about, will the US Federal Reserve be successful or not? Sometimes it's all about the journey, not about what the final destination will be. So I would still wait and hold judgment in terms of how the cycle is likely to play out.
Yeah, thanks, Vetri. So we will move to the second question. This is a question to Amit. The question is like this: while the demand outlook continues to remain strong for Indian IT companies, there seems to be a very moderation in revenue generation led by supply side challenges, high attrition, etc. How is UTI Value Opportunity Fund positioned to navigate from the near-term headwinds of the sector?
Yeah, thanks, Niranjan, for the question. As you know, we have been positive on the IT sector in early part of 2018, and that was primarily driven by our judgment of free cash of the valuation at that time, and comparing it to the free cash flow yield of the sector as well as the market. So on a relative basis, IT sector was very attractively placed at that time, given its history of delivering almost double-digit growth over the last 2 decades. We are positively inclined in terms of sector outlook of revenue as well as profitability. We think that expenditure on IT as a percentage of overall revenue is increasing across the globe. Indian IT companies have demonstrated both scale as well as skill and the execution capability to have an increasing share of that pie. And that actually had led us to having a positive view on the sector. But we have to also pause and see that the Indian IT sector is primarily delivering its services to the developed markets, which nominally are growing around 5 to 7%. In the late stage of 2021 or early 2022, markets started pricing in implied growth of the IT sector at close to mid-teen levels across the company, across the companies, which created slight discomfort, given that I had already explained. One main lever that we use is sectoral valuation. And since the market was pricing in implied growth of mid-teen against the delivered growth by these same companies at close to double digit, we turned underweight and we have reduced exposure to the IT sector, and it's almost 2.5% underweight now. And this reduction in exposure is driven only by valuation concern. At a more fundamental operational level, companies are doing really well.
Yeah, sure. Thanks, Amit. So we will move on to the next question. This is a question again to Vetri. China's economy is currently growing well below their long-term averages. How will its slowdown likely to impact the world economies due to the pressures of deleveraging, COVID-19 lockdowns, which is currently there? And what is the risk to India in particular?
Sure. Interesting question, Niranjan. Right now, most of the world is fighting inflation. They are tightening monetary policy. They are tightening fiscal policy. China is actually going the other way. They are actually starting to loosen monetary policy, and recent pronouncements suggest that they will also loosen the fisc and encourage spending in infrastructure. Their target announced earlier this year was 5.5% GDP growth, but I think if you look at most economists' estimates, or even those of the IMF, they are all expecting growth to be much slower than that. So I think there are issues as far as Chinese growth is concerned, and the recent COVID-19 related lockdowns certainly do not help Chinese growth. But it's also important to see China's role in the larger global economy. It is the world's largest exporter. So, if they are going to go through lockdowns and supply disruptions, supply chains get affected everywhere in the world. They are also the world's largest, second largest importer. Right. So which means demand for a lot of the raw materials, intermediates, fuels that they place on the rest of the world are likely to go down simply because their own economy is running at less than full, sort of utilization with a sort of negative outlook. So in effect, I think the problems in China, obviously they will have the maximum impact on that country's GDP, but it has a negative impact on global growth in general, which is not good for anybody. From India's point of view, I won't really say there is any risk from what is happening in China, except to the extent that if there are certain supply chains which pass through China, we may also get slightly impacted at the margin. But I don't necessarily see any direct challenge from what's happening in China to India. I think the risk in general is one of continued supply disruptions, one of continued weak global growth, neither of which is good for India. We would be in a far better situation if global growth was strong and if there were less supply disruptions across the world.
Yeah, sure. There is a question which is coming from Mr. Ramesh Bhojwani. His question goes like this, and Vetri, you can take this question again. So over the last few months, the interest rate hikes, rising the bond yields, and selling from FPIs have taken a toll on the markets. While the current time may be seen as an opportunity for buying, the March quarter corporate earnings have added to the volatility. So how should investors traverse the volatility from now on?
Sure. So, as I keep saying, you cannot predict news flow. You cannot predict events. And therefore, you must have a methodology to deal with volatility, which has nothing to do with volatility, but is based on valuations, right? If you go back and see our monthly market insights, you look at the publications that we do, updating our market views on a monthly basis, you will see that, we had started expressing discomfort about valuations all the way back very early. Invariably, we always indicate discomfort with valuations early, but all the way back in July of 2021, maybe even June of 21, we had started saying valuations are looking expensive. So, you have to decide whether you will use valuations or you will use events and news flow and react to them and then decide what the positioning should be. So I would argue that whatever you're seeing today, in a way, had already been signaled by way of the high valuations 6 or 7 months ago. But the good news, and I think is really in that sense, is that because earnings have gone up, and because the markets have gone nowhere for nearly 8 months, there is an effective derating which has taken place of the markets. The large cap section of the market has certainly pulled back into the fair value zone. Relative to bonds, yes, because of the spike in bond yields, not so attractive. But I would therefore stick to what I said at the end of my concluding comments. I think the time has come where one can start to make incremental allocations to the large cap space in particular and stagger it over a period of time, because we are still dealing with multiple uncertainties and risks at the current juncture.
Thank you so much, Vetri. There is one question on the banking sector. Apparently, Amit Premchandani is also fund manager for UTI Banking and Sector Fund. So, Amit, this is a question for you. So, banking is one sector where most of the market participants is bullish on for the over the last couple of years now, but continues to underperform the broader markets. So, with the expectation of good credit turnaround cycle and demand pickup, how bullish are you on this sector, and what are the triggers you are closely watching? This is a question from Mr. Shanmugam.
Thanks, Ranjan. If we just recall, 6 to 9 months back, everybody was really concerned about BNPL and fintechs eating the lunch of the banking sector. And 6 months is a long time. And we have seen in the US market, most of the fintechs have crashed by 75% to 80%. Given that that concern is now receding, let us look at more fundamental factors. India bank credit to GDP is even now less than 60%, and retail credit to GDP is somewhere around 20%. Which implies that India is a very underpenetrated market in terms of retail lending. On top of that, the need for offering digital services to the millennial, as well as the comfort of brick and mortar branch for traditional customer, is being felt by all the leading banks. And this is providing a unique advantage to large private sector banks, which have invested carefully over the last decade on providing up-to-date digital offerings, as well as expanding the distribution network so that more and more people or more and more Indians are bought into the financial sector or organized financial sector. So most of the large private banks have demonstrated agility in both the tracks. Capital level of private sector banks, especially as well as some public sector banks now, are at all-time high levels, which is providing, again, enough firepower to grow whenever nominal GDP growth revives, which will lead to a higher nominal credit growth. And lastly, but not the least, provisions, which was an overhang in the last cycle, and also an overhang, credit cost was an overhang at the early part of the pandemic, have started to trend down. And most of us had feared that the pandemic again will create a very long credit cycle. However, we have seen a very resilient retail book, especially retail catering to salaried segment. There have been some accidents on the SME or the self-employed side, but all these have been largely manageable. So we think that banking, especially lenders and large lenders, are likely to be a very strong beneficiary of the cyclical pickup in the domestic economy. Asset quality outcomes have been benign of the pandemic, and consolidation has happened in favor of large banks. So we are very actively overweight among in the large lending segment, especially the large private sector banks. And as you can see, over the last 1 quarter, we have increased our exposure in the banking and financial space, especially catering to the large private sector banks.
Sure. Thank you, Amit.
So I'll just add one line to what Amit said, and I think that reflects the perspective with which he manages the Value Opportunities Fund, and specifically a reference to the question which said, what are the triggers? right? I think the point I would want to make is that you will never know ahead of time what the triggers are. What you will only know is whether the businesses are in reasonably good shape, whether the valuations are attractive. The rest we will leave to the cycle to do its own tricks and its own magic, and we are willing to be patient. So that's the way to think about it. When the companies are fundamentally sound, we know what the longer term opportunity is. We don't have to worry about forecasting what will be the trigger in the next 3 months or 6 months. We don't think we have some exceptional tools to help us forecast that. What we get comfort in is all the things that Amit described.
Thanks, Vetri. That's very well put. Yeah. So there is another question to you, Amit. So this is on the mid and small cap segment. So despite of the recent correction in mid and small cap, so their valuation continues to be stretched relatively. So what's holding their valuation so firm? First question. And also, how is your fund navigating the opportunities in this particular segment? So this is a question coming from investor from New Zealand, Praful Kumar Patel. Yeah.
Thanks, Niranjan. As I, in the initial part of our session, said that of the 3 levers that we have, the third lever is moving across market cap based on valuation consideration. And as Vetri showed in the valuation chart, mid and especially the mid and small cap index is trading at a premium to its history on the price to book, and the mid cap index is trading at a premium of I think around 10 to 15% as compared to large cap. So valuation is not in our side in small and mid cap at the current moment. Hence, we are using that lever to actually reduce our small and mid cap exposure, which was at peak at 34-35% and has now gone down to 31%. Please keep in mind the classification of mid and mid cap especially changes based on what get classified as mid cap based on MFI, and some of the definition has gone against us and increased our mid cap exposure on some of the stocks which we had bought as large cap, and also some of the IPOs which have come have been classified after listing as large cap, which have moved some of the tail end of the large cap into mid cap, and that has created the illusion that our mid cap and small cap exposure is getting higher. Actually, the exposure have been same, just that the classification changed to some extent. But despite that, we have been reducing our small and mid cap exposure gradually. But I would also point out that we just don't, we are not using these high valuation to indiscriminately change our market cap orientation. Just to give an example, in pharma sector, we find the valuation actually of mid cap, some of the mid caps are cheaper now as compared to large cap. So we are very comfortable in actually increasing some of the mid cap exposure in the pharma segment. Also, these companies are largely focused in the domestic pharma segment, which should kind of demand a higher valuation as compared to some of the other companies in the pharma segment among the large cap, which have much more diversified exposure and much more exposure to the overseas segment. And hence, we have slightly increased our mid cap exposure in the pharma segment. But at the same time, if you look at banking and financial services, we have been much more comfortable owning large cap names and actually reducing our exposure in mid cap and small cap name if we get an opportunity, because actually the large cap are very comfortably valued in banking and financial services, and also market share is shifting in favor of larger banks, and also the ROA profile or the return ratio profile of larger bank is very comfortable. In some cases, there are sectors like consumer durable, where actually most of the exposure that you can take is through mid cap. So we are not really getting stuck with the mid cap and small cap allocation in that segment. But at a more macro level, I would say that we have been reducing a mid cap and small cap exposure, and the trajectory will continue to be in that direction at a measured pace.
Thanks, Amit, for your thoughts. Due to paucity of time, I think we will take one last question. Maybe Vetri, this is a question for you. So this is a question coming from MFD, Mr. Rakesh Sudan. So while the markets are getting cheaper, so there is a paradigm change in the fund performance across the active funds, underperforming the respective benchmark indices. So what is causing this change in the trend, and how should investors see this return divergence? And also, if you can throw some light on growth stocks, which typically of high PE in nature, but having good cash flows. In fact, they have also underperformed significantly or recently over the few months. So, will they manage to generate good returns in the current market conditions?
Yeah, good question, Ranjan. Maybe I'll take the second part of the question first. See, when you think about investing, in my sort of opinion and philosophical approach, there are only two ways to manage a portfolio. One is a portfolio which, of course, no portfolio approach, in a sense, ignores the quality of the companies that you are investing in. The frameworks might be slightly different, the preferred metrics might be different, but I don't think any investing strategy says we invest in poor quality businesses. So let's take that as hygiene. Now, having said that, one way to navigate market volatility and challenges is to emphasize margin of safety, mean reversion, and those are kind of the attributes that get demonstrated significantly in a strategy like which is more value oriented, whereas in a growth oriented strategy you sort of emphasize the return on invested capital, the cash flow generating ability, and the growth runway that the company has. These are only two ways to sort of overcome market volatility. One is what I call the investor approach, which is where you emphasize margin of safety. The other is the owner approach, where you emphasize the underlying fundamentals of the business in which you are invested. Now, when you manage when you have a portfolio, the portfolio is bound to go through ups and downs. But these are the two risk mitigation devices which over time help you to navigate market ups and downs. So I think they're both slightly different approaches, but when you look at it over a longer period of time, both have demonstrated their ability to create alpha. What is most important is to be disciplined, which is you cannot keep trying to shift from one to the other. You need to stick to the approach which is either a growth, cash flow, return on invested capital, bottom up, long-term holding strategy, or something which emphasizes margin of safety more. But you can't keep sort of shuffling between the two. So there will be cycles in which growth does better. There will be cycles in which value does better. I think what we are seeing right now is some pressure on valuations because of the higher cost of capital. But over time, if those businesses do deliver on their return on invested capital and on their cash flow, then we know that in the longer term, businesses do track the intrinsic value compounding that comes from earnings growth and the return on invested capital. And I think that will work to the benefit of those companies. Once the market feels that we have got to the point where longer term rates now reflect the sort of neutral rate of policy. Now, remember, short-term rates, we talked about the US Fed, they may still have to do 6 or 7 rate hikes, but the long-term bond is already 3.2%. And one could argue that maybe the neutral rate is, 3.5, 3.75. So once the market gets the comfort that the longer-term rate is anchored, then I think you will start to see the growth, sort of companies start to do slightly better. Right now, that anchoring is still missing, but don't focus on the short end. Companies are not priced off the short end of the yield curve. They are priced from the anchor of the long end of the yield curve.
Yeah, thanks, Vetri. You want to take the second part of the question? So return divergence.
Yeah, I think, return divergence is always going to happen for the reasons I mentioned earlier. Sometimes markets are concentrated, sometimes they're diversified, sometimes, you can see performances varying across market cap spectrum. And finally, depending on the kind of mood the market is in, one particular style may tend to do better than the other. So I think these are just cycles. There are, in my opinion, there is no strategy which can deliver alpha day in and day out, but over the period of a cycle, if a strategy is implemented in a disciplined fashion, it can create alpha, but you can't expect the strategy to, create that alpha. So I think what you're referring to is perhaps more the divergence on a short-term frame, but typically look at it over a 5 to 7 year basis. I think that's when the alpha generation capability starts to show up more significantly.
Sure, Vetri, thanks a lot. Just a request to the participants here today. So please share your feedback on the topics covered today and also the overall quality of the webinar using the chat box. It will help us to do better in our upcoming engagements with you. Thanks. And yeah, back to Vetri for closing remarks.
Sure. Thank you, Niranjan. And thank you, Amit. I hope this session was useful for everybody who's logged in. We look forward to your continued participation in the monthly market insight. We hope to be able to answer the questions that you all send us in advance, as well as during the webinar. The more questions we get, the better we are able to sort of address thoughts that might be on your minds or on the minds of other investors. And we hope we've done a decent job of that today. Thank you very much. Have a good evening and have a wonderful summer ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.